A couple of days ago, the Bank of Canada issued a statement. Let's listen to part of the statement.
In Canada, uncertain global and domestic economic conditions are delaying the pickup in exports and business investment. This leaves the level of economic activity lower than what the bank had been expecting. Slower growth in household credit and higher mortgage interest rates point to a gradual unwinding of household imbalances. The outlook for inflation is subject to several risks emanating from both the external environment and the domestic economy. There is a possibility that for a given projection of economic growth for the world, exports could be even weaker than assumed.
So the Bank of Canada is not very optimistic about the world economy right now. As you can see in this Wall Street Journal article, they say, in a surprise shift, the Bank of Canada Wednesday abandoned the rate hike bias it had held for 18 months, noting that downside risks to inflation are growing in importance amid softer than expected economic growth. So in essence, what the bank is saying here, the bank has been saying for 18 months that they will hike the rates, and now they're saying no, we're going to keep the rates. Okay, and they go on to say the overnight rate has stayed at 1% since September 2010, the longest period of no change since the 1950s. Are you kidding me? And now they're saying they're going to keep the interest rate. Now they're saying that they're going to keep the interest rates at 1% for the foreseeable future. This is ridiculous. And they can't just go in and say, yeah, we're just going to keep the interest rates low. We're going to keep them at 1%. They actually have to do something about it. And Gregory Mannarino actually explains this the best way. Let's see what Greg says about that.
What the Central Bank of Canada, the Philippines, Norway, Sweden have decided that they are also going to be following in the footsteps of the Federal Reserve and artificially suppressing interest rates by printing cash out of thin air and buying bonds and buying assets. Understand, people, this is a concept I've gone over many, many times. A central bank cannot just say it. They can't just go, hey, we're going to keep interest rates low. They have to actually get into the market and make it happen.
So essentially what the bank is doing is they're printing money out of thin air and buying bonds with it. Mike Maloney in his Hidden Secrets of Money episode 4, he actually explains the scam, the way the government and the central bank basically exchange IOUs to print money out of thin air.
So what's a bond? If you think about it, a bond is really nothing but a glorified IOU. It's a pretty piece of paper with numbers printed on it that says, loan me $1 trillion today, and I promise over a 10-year period I'm going to pay you back that $1 trillion plus interest. But what you need to understand is that Treasury bonds are our national debt. These glorified IOUs are to be paid back by you and I and our descendants through future taxation. Therefore, when the government issues a bond, it steals prosperity out of the future so that it can spend it today. The Treasury then holds a bond auction, and the world's largest banks show up and compete to buy part of our national debt and make a profit on it by earning interest. You'll notice that as we move through this process, the big banks are there, taking a cut every step of the way. This isn't by chance, as you'll see shortly. Then, through a shell game called open market operations, the banks get to sell some of those bonds to the Federal Reserve at a profit. To pay for the bonds, the Federal Reserve opens up its big old checkbook and writes bad, bogus, counterfeit checks that should bounce because they're drawn on an account that always has a zero balance. There isn't one penny in there. To quote from the Boston Federal Reserve, when you or I write a check, there must be sufficient funds in our account to cover that check. But when the Federal Reserve writes a check, there is no bank deposit on which that check is drawn. When the Federal Reserve writes a check, it is creating money. The Fed then hands those checks to the banks, and at this point, currency springs into existence. The banks then take that currency and buy more bonds at the next Treasury auction. But what is a check? A check is also an IOU. When you write a check, you're making a note that says, here's my IOU for cash. All you have to do is go to the bank and pick it up. Now it's very, very important that you understand this process because we're going to come back later and show you the devastating effect this has on you. The Treasury issues IOUs, bonds. The banks then buy those IOUs with currency. The Federal Reserve then writes IOUs, checks, and hands them to the banks in exchange for the Treasury's IOUs, the bonds. And currency is created. So what's really happening is the Federal Reserve and the Treasury are just swapping IOUs, using the banks as middlemen, and abracadabra, presto, currency magically springs into existence.
This increase in bank investments, which are not really investments since they're government IOUs, can be seen here on the Bank of Canada balance sheet. This is the oldest I could find, January 31st, 2009. This is straight off of the Bank of Canada. And at January 31st, 2009, the Bank of Canada held almost $42 billion in Treasury bills of Canada and some other bonds, Canadian bonds. They're all basically Canadian bonds. At August 31st, 2013, so just 4 short years later, we see that the investments here at the end of August, 87 billion. So they doubled their holdings of government debt. The central bank has doubled their holdings on government bonds. So their balance sheet is just exploding, doubling in 5 years. This is just ridiculous. And this is all debt. It's all debt that they're holding. So the way they do this is they go into the market and they print cash out of thin air, and they go in and they buy these bonds because nobody else would give the government money at this lower rate. So the central bank has to come in and print all this new money to buy these bonds to keep the rate this low. And if they want to lower the rate, as they're talking about, that will increase their balance sheet even more. They will hold even more worthless debt on their balance sheet because none of this debt will ever be repaid. Anyway, I thought you people should know that because you should know when your money is being debased, because they're debasing your money. By printing all this currency and buying all these bonds, they are debasing the currency that already is in existence. So all of the money that you people hold in your pockets, it is being diluted by these central bankers. Thanks for watching, YouTube.